Today we're looking at an analysis report, the opening bell report, why APLD is my top watch list pick this week.
Very high energy.
Extremely. It makes a really bullish case for buying the dip on Applied Digital after that 9% drop.
And it has the numbers to back it up, right? That 84% year-over-year revenue growth, those high analyst targets.
Exactly. The foundation is there, but to really land this with a skeptical investor, we think there are a few opportunities to strengthen the logic. Let's jump right into the first one, which is all about risk.
Yeah, the decisiveness is great. I mean, it's what you want to read, a strong point of view.
Right.
But a strong point of view is only as good as its defense. So that first area for us has to be about, completing and balancing the narrative.
Precisely. So while the report does a good job framing that 9% drop as just profit-taking,
Which is, the standard explanation.
it is, but the argument would be so much stronger if it really incorporated and then, neutralized the potential counter-narratives. It can't just be a cheerleader piece. It has to feel like a full assessment.
Well, that's the weakness right now. It's how quickly it dismisses some pretty legitimate concerns. The line is, the fundamentals haven't changed, only the price has. And it justifies the cash burn as building the future.
Right.
And that super optimistic angle, it just sort of glides over the real reasons why sophisticated investors, the ones who actually move the needle, might be selling. It's too simple to call it all profit-taking.
Ignoring the bear case doesn't make it go away. It just makes the analysis feel, incomplete. The goal should be to show the reader you've looked at the negatives and then the thesis still holds.
So the suggestion is pretty straightforward.
Yeah, a dedicated, concise section, call it risk assessment or the counter-narrative, something that acknowledges and then strategically dismantles the biggest challenges. That move alone massively boosts credibility.
And you have to get specific with those challenges. So let's start with the cash burn. Instead of just saying they're burning cash to build, we need to detail the actual financial risks of that model.
Like what?
Well, for instance, how does the current interest rate environment really impact the economics of these massive build-outs? That's a huge question.
That's critical for any infrastructure play. If APLD is leaning heavily on financing for these huge HPC centers, the cost of capital is everything.
Exactly.
So the analysis needs to paint that picture. If you need to raise, say, $400 million for the next data center, the difference between debt of 4% versus 7% is, it completely changes your future profitability.
It crushes your margins. That's the headwind that the smart money is actually pricing in.
Right.
Access to cheap capital is the fuel for this kind of growth. If that fuel gets more expensive, the whole expansion story, the core of the bull thesis, is suddenly under pressure.
So the report needs to acknowledge that pressure and then explain why APLD's model is maybe better equipped to handle it than its competitors?
Yeah, maybe they have strategic power agreements or locked-in contracts. You have to give a reason.
I agree financing risk is huge. But doesn't the insane demand for AI infrastructure right now mean they can just pass those costs on to clients? Isn't customer concentration the bigger, more immediate risk that needs to be tackled?
That's a fantastic point. And it's the second risk you have to address. The report leans on the connection to NVIDIA and the big boys, which is great. But that also implies concentration.
So you have to be transparent about it.
You do. If, 3 clients make up 80% of your revenue, which happens a lot in this space, you have to state that's a concentration risk.
And then how do you neutralize it?
You show how sticky those relationships are. Acknowledge the risk, but then immediately explain why it's manageable for APLD. Are these multi-year, non-cancelable contracts? Take-or-pay deals?
Ah, okay.
And if a major client wanted to build their own stuff, how long would that take? What's the barrier that APLD has already solved? If you name the risk and then detail the contractual moat, the buy-the-dip case becomes instantly more defensible.
It shifts the whole frame from just hoping for the best to strategically proving the downside is contained. I think that balance would really mature the whole piece.
Agreed. Okay, so moving on, let's talk about the how, the execution part. The strategy is clear, but I think the analysis undersells why that specific entry point is the right one.
Right. Let's pivot to the execution strategy. The report gives a very clear plan, but the analytical foundation for it needs some work.
The call to action is a definite strength, no question. It tells you exactly what to do.
Yeah.
But the why, the reason that price level is the one to watch, that could be a lot more robust.
The weakness is that it flags the, $27 to $28 level and says to look for a green candle or a bounce on Monday or Tuesday.
It's just too generic.
It is. It's clear, but there's no explanation for why $27 to $28 is a key technical or psychological level. It just happens to be the recent low. And the green candle signal is, it's pretty weak for this kind of high-conviction call.
You have to give the reader confidence that this entry point comes from deep analysis, not just looking at a recent dip on a chart.
So, what's the suggestion?
You have to ground that stabilization zone in specific technicals or, even better, in fundamental valuation metrics. That makes the entry so much more compelling and less about just, generic market sentiment.
Okay, so this is where we have to connect the growth story to the stock chart. The author needs to explicitly link that $27 level to a real metric. But how do you use 84% revenue growth to justify a technical entry?
Well, this is the secret sauce, right? Does that $27 price point, when you look at forward revenue estimates, happen to align with, say, a 10 times price to sales multiple?
I see.
If you can show that the sell-off pushed the stock down to a valuation that is historically a bargain for a company growing this fast, you've just given your technical level a fundamental floor.
And that's why $27 becomes so interesting. It's not just a line on a chart. It means you're buying explosive growth at a discounted multiple.
Exactly. It gives the argument a second, immovable leg to stand on. It's no longer just a guess about where the stock might stop falling. It's a valuation-based hypothesis.
Okay, but we still have to refine the signal for the bounce. A green candle isn't enough. Why is something like volume confirmation so much better?
Because we're trying to separate retail hype from institutional defense. The goal isn't to catch a falling knife right at 27. We've all been burned doing that.
For sure.
A strong signal is about stabilization. So instead of a generic daily candle, the analysis should suggest waiting for a higher low formation on a shorter time frame, like an hourly chart, after that initial low has been tested and held.
So you confirm the level holds first, then you look for the move up.
Yes, and what's even better is volume confirmation. A real signal that institutions are stepping in is a volume spike on that reversal that's way higher than the 10-day average.
So that shows big money is moving in to defend that valuation floor.
That's the confirmation. That pause, that stabilization, it tells you the knife has stopped falling.
That really elevates the entry from a guess to a strategy. Okay, let's move to our third and final point, which is about adding more muscle to the core business thesis.
Yeah, the core story's fantastic. APLD as essential AI infrastructure, but it's painted in broad strokes right now when it needs sharp, fine details.
The material makes his really powerful claim that APLD is crucial to the AI supercycle. It's selling the power, building the core infrastructure, but the connection between their specific operations, these HPC centers, and their actual competitive advantage, it needs more granular support.
The weakness is its reliance on that broad picks and shovels analogy. And the idea that you can't have AI without the power. Which is true, of course, but it's a generic truth. It applies to utility companies, fiber providers. It sort of dilutes APLD's specific value. The real question is, why them?
So the suggestion here is critical. We need specific operational metrics, details on the unique capacity or tech advantage of their HPC centers, something that proves they're proprietary, not just another interchangeable provider.
Right. We need to quantify things beyond that 84% revenue growth number. For example, what are their contracted capacity utilization rates? You can usually find that in an investor deck.
And if they're at, say, 95% utilization with the next 3 build-outs already fully contracted?
That's an incredibly powerful data point. It demonstrates overwhelming demand and solid execution. It's specific.
And what about the tech? The big boys need specialized gear, right?
Exactly. You need to detail the specialized GPU infrastructure they have. What are the technical specs that separate them from a generic data center? Talk about power density or advanced cooling solutions that are required for these high-end AI chips.
That changes the narrative from they build data centers to they build specialized, high-demand AI infrastructure that few others can.
It grounds the whole story in reality. It justifies their position as a preferred partner. And we can even take it one step further.
How so?
Give a concrete example of how their operational scale creates a competitive moat. How fast are their build-outs? If they can stand up a new HPC center in 3 months when the industry average is 9, that is a verifiable fundamental advantage.
Or maybe it's their unique energy position. Power is the real bottleneck for AI compute.
Absolutely. If the report can highlight that they hold unique long-term favorable power purchase agreements, that's a massive advantage. Cheap, reliable power at scale is the holy